You do not need to be a billionaire to own a bank. Right now, today, there are ordinary people, teachers, nurses, small business owners who legally own a piece of a bank, and some of them started with less than $100. Stay with me because by the end of this video, you understand exactly how banks get owned, what it really costs at every level, and which path fits your pocket right now. Why this feels impossible, but isn't. When people hear own a bank, their mind jumps straight to Wall Street movies. Men in suits, private jets, billions of dollars sitting in a vault. That picture is not wrong, but it is incomplete. Owning a bank actually happens on 3 very different levels. Level 1 costs you the price of a nice dinner. Level 2 costs a few $100,000. Level 3 costs tens of millions. Every single one of these levels gives you real legal ownership. The difference is how much control you get and how much money you bring to the table. So today we break down all 3 with real numbers and real steps. Level 1, buy bank shares. The simplest, fastest way to own a bank starts with the stock market. When a bank is publicly listed, it sells shares to anyone who wants to buy them, and every single share represents a tiny piece of ownership in that bank. Here is the number that surprises most people. You can buy a share in a major listed bank for as little as $5 to $50, depending on the bank and the market. Some brokerage apps even let you buy a fraction of a share for as little as $1. That means with $100, you already own a real legal documented piece of a real bank. You get a shareholder certificate. You are entitled to your share of profit, called a dividend, paid out often once or twice a year. Now, owning 10 shares does not make you the boss. You will not be approving loans or setting interest rates. But you are legally a part owner, and if that bank grows, your shares grow in value with it. Some long-term shareholders who bought bank stock decades ago have turned a few $1,000s into 6 figures, simply by holding on while the bank expanded. This is where most people should start because it teaches you how banking businesses actually make money, through interest, fees, and lending before you ever think about bigger levels of ownership. Level 2. Start a digital bank or neobank. The second level is where things get exciting. Digital banks, also called neobanks. A neobank does not need physical branches, security guards, or marble floors. It runs entirely through an app, so the cost of starting one has dropped dramatically compared to a traditional bank. Here are the real figures. Depending on the country, getting a digital banking license and the technology built to launch can realistically start anywhere from $500,000 on the lower end, up to $5 million for a more fully licensed operation with proper compliance, security, and a founding team. Some entrepreneurs get there faster by partnering with an already licensed bank behind the scenes, which can lower the starting cost significantly, sometimes into the low hundreds of thousands. This is exactly how many of the popular digital banks and money apps you already use on your phone got started. A small founding team raised money from investors, partnered with a licensed banking institution, built an app, and launched. Within a few years, some of these companies were valued at over $1 billion, and the original founders, who may have started with a few $100,000, became owners of something worth an extraordinary amount. This level requires you to either raise investment money from others, or already have meaningful capital and a strong business plan. But it is genuinely achievable, and it is happening every single year in every region of the world. Level 3. Build or buy a full traditional bank. The third level is the one most people picture when they hear owning a bank. A full, licensed, brick-and-mortar commercial bank that can take deposits and lend at scale. This level is expensive, and I want to give you honest numbers, not fantasy numbers. In many countries, regulators require what is called minimum capital, money you must prove you have before they even consider your license. In some markets, this figure sits around $10 to $20 million. In larger economies, a brand new commercial bank can require $20 to $30 million or more in starting capital, simply to prove to regulators that the bank can absorb losses and protect customer deposits. There is also a second route at this level. Instead of building from scratch, you buy an existing, already licensed bank that is struggling or looking for new owners. This can sometimes cost less than building one from zero because the license, the customers, and the branch network already exist. Buyers in this position have picked up smaller struggling banks for anywhere between $10 million and $100 million, depending on the bank's size and condition. At this level, you are not doing this alone. You typically need a group of investors, a strong management team, years of regulatory paperwork, and patience. This process alone can take 1 to 3 years before you're approved to operate. Most owners at this level are not a single person, but a group who pool resources together, which is exactly how many of the world's biggest banking institutions actually started life. The regulatory journey. No matter which level you choose above level 1, every country has a central authority that regulates banks, a central bank or a financial regulator, and the journey to get their approval follows a fairly similar pattern almost everywhere. First, you write a detailed business plan showing exactly how your bank will make money, who your customers are, and how you protect their deposits if things go wrong. Second, you prove your capital. The regulator wants to see real money sitting in a verified account, not just a promise on paper. Third, you submit your full ownership structure showing every single person or company that owns a piece of the bank, because regulators care deeply about who is really in control behind the scenes. Fourth, background checks happen on every major shareholder and director, since regulators want people with clean records and real, relevant experience running a bank. Fifth, if everything checks out, you receive a license, sometimes with operating conditions attached, and you can finally open your doors for business. This journey rewards patience and preparation far more than it rewards luck, and rushing any one of these steps is usually what causes an application to get rejected or delayed by years. Real talk. Risks you need to know. I care about you too much to only show you the shiny side. Bank ownership at any level carries real risk. Bank stocks can drop in value, sometimes sharply, when the economy struggles. Digital banks can burn through their investment money before they become profitable, and some shut down within a few years. Traditional banks can fail if they lend badly or manage risk poorly, and owners can lose their entire investment. The people who succeed at this are the ones who start at the level that matches their current resources, learn the business deeply, and grow their ownership stake over time, rather than jumping straight to level 3 with money they cannot afford to lose. Patience is not the boring option here. It is actually the strategy that protects you. So here is your real takeaway. Owning a bank is not one door, it is 3 doors, and one of them, buying your first bank share, is open to you this week with whatever amount you have, even if that is just $20 or $50. Start there. Learn how the business works from the inside. Let your ownership grow as your knowledge and your capital grow. That is exactly how today's biggest bank owners started too. If this video helped you see banking ownership differently, hit like, subscribe for more videos like this, and tell me in the comments. Which level are you starting at? I read every single comment, and I will see you in the next video.